Hello everyone and a very warm welcome to today's major markets update for Friday, February the 28th, 2025. This is the last day of this month and we only have 10 left for 2025. We are storming through the year like there is no tomorrow. However, let's go straight to some of our Elliott Wave stuff. We believe we've either bottomed here for a smaller fourth wave, though it seemed pretty big, or an even larger fourth wave. This means we're either going to see one more up, one more down, and then the last fifth wave up, or we are all done and all we're going to see is one last fifth wave before a very large multi-year bear market starts. However, we cannot yet tell exactly which one it is, though the preferred scenario, I must admit, is that this is a smaller fourth wave. We'll see a 3, 4, and 5, as we will share for the Dow Jones. So let's go straight to the chart. We're going to start off with some different charts for this time. I want to start off with, I would say, secondary analysis. That is, in this case, sentiment. Today, the CNN Fear Greed Index was at 16, which is extreme greed. The last time we were that low, actually a little bit higher, was August 5th, 2024. That's when the market put in a significant bottom and started rallying pretty much till last week. So oftentimes, this is a good contrarian indicator. To add insult to injury is the AAII Investor Sentiment Survey, which only had 19.4% bulls and 60% bears. This is an extreme reading, and oftentimes these are very good contrarian indicators, meaning when everybody is fearful, please get greedy. And when everybody is greedy, please get fearful. And as you can see, everybody was extremely fearful. But interestingly, the stock market, like the S&P 500, topped last week. It just put in an all-time high last week. These are sentiment readings that coincide with the end of bear markets. For example, 2022 and 2009. This is how low sentiment readings from AAII currently are. So this is really extreme after only 5 or 6 days of selling. This matches with our Elliott Wave count that we've just completed, a C wave of a fourth wave. Now we're also going to look at other external evidence, and this is seasonality. Now seasonality is hit and miss. As usual, 60% of the time, it works all the time. That goes with everything, even the Elliott Wave. Okay? Why? Because sometimes we misinterpret the market, and sometimes the market just doesn't follow seasonality. Sometimes negative divergence doesn't work, sometimes it does, etc. If you get that, you understand that 60% of the time everything works all the time, you're good. So these are post-election years, and we get 25 years combined since 1929. And as you can see, we have pretty much just completed the most bearish period in the spring, or the first half, I would say, of 2025 of a post-election year. Okay? And this matches quite well with a low late February, a rally into mid-March. Then we'll see a decline into April, and from there we'll rally all the way into July, hopefully. This doesn't mean this is set in stone. This is simply a roadmap, and we'll see how much it's going to vary from this roadmap. I do know we have a Federal Reserve meeting with a rate decision announcement on March 19th. So that would match pretty well with a potential top here. It wouldn't surprise me if the Federal Reserve is going to keep interest rates steady and the market is not going to like it. So we'll see if we're going to rally into mid-March. That's now critical. If we do, this pattern keeps on tracking. However, it doesn't track all the time, so please do not hang your hat on this. This is something we follow. However, it matches once again with the Elliott Wave count. It matches, of course, with sentiment being completely washed out right here at the lows. And the AAII sentiment, by the way, is from Wednesday through Wednesday. So it gets published on Thursday, meaning this is through Wednesday, and pretty sure it got soured much more the day after. Now here is a market breadth indicator, and this is for the S&P 500 cumulative AD line. So the cumulative AD line, as you can see, topped here in November last year. And then it started to make lower highs, whereas the market started to make higher highs. That is called negative divergence. So we've connected the previous all-time high with the tops here and there. And as you can see, today, the stock market or the underlying market breadth broke above those. So the downtrend has been broken. Most of the time, breadth leads price. So this is a positive development. If breadth continues as is and it's going to make a new all-time high, then a long-term bear market is avoided for the near term. It means we won't see a long-term bear market, meaning 1 to 2 to 3 years, until we see long-term negative divergence. I've shared that chart with you before. So this is a positive. It means the market has already broken above its breadth downtrend. So that's a very good sign. This is very good. Let's look at our PMO buy and sell indicator, and it's been bottoming out over the last 2 days. And here you can see a short-term history, and every time we start to bottom at 0, as you can see, all these blocks, we get very good buy signals. We now need to see a green up candle, and then we have a buy signal. Okay, it doesn't mean price will just instantly straight go up. It means that the risk reward is really there. So this is an additional line of evidence that most likely a new uptrend has started. Okay, look here in December last year, new uptrend started. And of course, we eventually get a downtrend, and a new uptrend started here May last year. Okay, voila. And here in August, a little bit late, but there you go. And then we definitely got a serious pullback. So it doesn't work brilliantly all the time, but it does. Here again, new uptrend. Here again, new uptrend. And then here again, a new uptrend till you get the sell signal. It doesn't work all the time, 60% of the time. It works every time. But this means that now the risk reward is skewed towards reward. It adds weight to the previous evidence. How are we doing for our intermediate term indicator? Well, it went to a sell already in late February, and it remains on a sell. This is, of course, a slower moving indicator, but for now it's on a sell. So it is a sell, and we must say that is a negative. It is a smudge on the window for the bears. Once it turns to a buy, for example, like we did here in January, then we'll add that to the weight of the evidence as well. Let's look at the S&P 500's McClellan oscillator. What is the McClellan oscillator? It is simply the difference between how many stocks are advancing and declining. And of course, you also have some that don't move at all. They're pretty much steady for today. And if you have a positive number, it means more stocks are advancing than declining. Today we had a positive number, and as you can see, the McClellan oscillator hasn't been that bad. It hasn't been as low as minus 120 like we did, for example, here in December last year, or here at the April of 2024 lows, or here at the August lows. So all in all, the market has held up pretty well. This is not too bad. All things considered, why so serious, right? That's the famous quote from the Joker in one of the recent Batman movies. Why so serious? Why are we so negative when actually under the hood it's not that bad? Okay, these are not minus 100 readings. These are just minus 10, minus 20. So that means that the summation index, which is the McClellan oscillator reading for today, added to that of yesterday, which was added to that of the day before, etc. So it's a summation. Is still on a buy. It just narrowly avoided a sell signal. A buy is a buy, and that's what it remains. So despite the recent sell-off, the summation index is not on a sell signal. As you can see, it is above its moving average. And as such, this is also a positive for the bulls. Now we're going to look at the price charts. So this is the NASDAQ. This is a line chart, which means it only registers closing prices. This was our alternative wave count, where we said, well, we are in a wave, then a B wave, and we're going to see a C wave. Okay, and that is what we got. It wasn't our preferred wave count. This was our alternative. Unfortunately, I am unable to give a percentage to these type of wave counts. There's no way for me to quantify what percentage chance there is to alternative versus a preferred wave count. The preferred one is when you, for example, see an index make new all-time highs to, of course, have a bullish wave count. And therefore, what we saw for the S&P 500 and for the NASDAQ 100, we preferred a C wave higher after a small pullback. So something like this was then all of wave 4, and then we had ABC for A, ABC for B, and then ABC for 5. That was our preferred wave count, knowing that we could not break below key price levels. And that's unfortunately what happened. So the alternative became the preferred. This is true good Elliott wave, where you are aware of the possibilities. The market is stochastic, meaning there are many variables that make the market, and it is probabilistic, meaning there are always chances that something else is going to happen than what you think it will. Just because the chance is 1% doesn't mean it won't happen. It can really happen. Okay? So what we have here is, in our humble opinion, a expanded flat. An expanded flat, as you can see here, is where B equals A. So this is wave A and this is wave B. And as you can see, we got pretty close to the beginning of wave A. And then, of course, the C wave is longer than the A wave. Okay, so here we had 3 waves lower, 3 waves back up, and now 5 waves lower. So this is a 3-3-5. And if we look at the hourly chart, which I will show you for the NASDAQ 100 in a moment, you can see we really completed a nice 5 waves lower. I would have liked ideally to see the market bottom here, but beggars can't be choosers. Why? Because when the flat finally kicks in and we have it confirmed, which for us was a break pretty much below the 19,300 for the NASDAQ, we don't know if it is going to be a regular flat. We don't know if it's going to be a running flat or an expanded flat. We cannot predict the future. We really can't. We have to go day by day, knowing that it will be a flat. How exactly, we don't know. So far, this market has bottomed right in a normal Fibonacci retrace level at the 100 to 123.6 for this wave 4. Okay, nothing out of the ordinary. And we now expect this wave 5 to be underway, contingent on holding above key price levels, which we will cover for the NASDAQ 100, S&P 500, and the Dow Jones. Talking about the Dow Jones, we had a very strong reversal candle, and we can now count 5 waves down from this B wave high. 1, 2, 1, 2, 3, 4, 3, 4, 5. Okay, so you can see that really nice. And this is honestly as good as it gets. And we only broke below the first warning level for the bulls, which were adjusted yesterday. Today was a very strong reversal. We're still above the second, the third, and the fourth. As you can see, all downside target boxes have been reached. The C wave, the C of the C wave, and the 2/B. So we are getting very close to invalidating a 1, 2, 3, 4, 5 setup, as the market, in this case the Dow Jones, need to break above 43,879. Currently we got 43,873. So yes, we could see another 5 lower, but this is really getting close. This is a very nice strong reversal on positive divergence on the RSI 5 from oversold levels that previously oftentimes also led to good bottoms. This is the monthly chart for the S&P 500 of Dow Jones. And as you can see, we expect a 3-wave advance to complete this 3rd wave, and then a larger 4th wave, and from there a larger 5th wave. So this matches what we just discussed in the opening slides, that we prefer to see a larger 4-5 setup. Here we have the hourly chart of the NASDAQ 100. We believe it has made 5 waves lower for this, what we would call irregular expanded flat. All right, it is irregular because the B wave went above the start of the A wave, which is the wave 3. ABC lower, ABC higher, 1, 2, 3, 4, 5 waves lower. Here we have what looks best like a ending diagonal wave 5 in gray, this one. 1, 2, 3, 4, and a very extended wave 5. And we've now broken almost above the first warning level for the bulls. There's plenty of positive divergence on the RSI 5. Remember, all those divergences are conditions, not triggers. We've bottomed here in a very good zone for the MACD, and also the money flow is exhibiting positive divergence. So we can consider this red wave 4 complete, but of course there's way too little information for that. However, what we previously discussed, sentiment, seasonality, and market breadth all point that a significant low is in place. Looking at the daily chart for the NASDAQ 100, here we can have a clearer picture of this ABC pattern that I just discussed. So we have an ABC lower, ABC higher, and then we have 5 waves down. Picture perfect. We're holding above key warning levels. And also here we now have what we call a irregular expanded flat wave 4, almost to the 76.4% retrace. And then a 5-1 relationship to target, ideally the 176.4% extension, in this case at 22,826. We got extremely oversold, so this looks really good. And most of the time that leads to considerable rallies, as that's what we've previously seen. Moving on to the alternative wave count, and that is that we have put in a much larger top, a wave 5 of 5. And we've just completed a impulse lower, because we did do 5 waves lower. Okay, it means that we have completed a ending diagonal wave 5. Ending diagonals are all 3 waves. Okay, so we have here pretty much A, B, C, A, B, C, and then here again A, B, C, A, B, C, A, B, C. That is the anatomy of a ending diagonal. So this is still very possible, and the alternative has us bounce ideally to around 21,500, 21,700 before we see a waterfall decline. Now again, I showed you the seasonality chart. This looks not in line with seasonality, but seasonality is an average. So we must, of course, present this alternative with the warning levels for the bears on the chart. If we go above 21,848, chances really start to increase that this is not going to happen. But we have to show the possibility after 5 waves lower. Again, I prefer this to be a 4th wave, but it can be counted this way. We're pretty much just showing you the possibility, the potential that is in the chart. I can interpret it this way. So if we at some point move higher and then break below today's low, all bets are off, and we're most likely going to go to the low 18,000s for this wave 3/C. And then we'll have to see if we're going to get a 4 and a 5. And that then will be a much larger A/1. We'll get back up again, and then we go much lower. Okay? So that is our alternative. Our preferred wave count is once again for this completion of the wave 5 of 5, in line with what we saw for the Dow Jones. Here is the S&P 500, our preferred wave count for the irregular, in this case, running flat wave 4. So we have 3 waves lower for A, 3 waves lower up for B, and then 5 waves lower for C. And this is a running flat because wave 4 ended above the A wave. Okay, so far so good. And you can see here the decline since this gray wave 4, which was a high made earlier this week, follows a nice, reasonably nice Fibonacci extension pattern. If we look here at the technical indicators, we have plenty of positive divergence, which is a good sign, but those are conditions, not triggers. And you see here, as the market moved lower, more and more money was put into the market. That's always a very good sign. And we've broken above the first warning level for the bears. The next one is 6,009. Above that, 6,084, and then 6,147. So this is our preferred wave count. It wasn't our preferred, this was our alternative, but the market invalidated the preferred wave count by breaking below key levels. In this case, I think it was about 5,900, and it already gave us a warning at around 6,000. And what we originally had, I believe, on Friday was that the wave 4 had completed here, and that we were either doing a smaller a pullback and then a rally, or we would see a larger pullback and then a rally. Okay, this pullback got even more extensive. So this looks like a running flat. Also here, very close to the 76.4% retrace. So we expect now a wave 5 to the 176.4% at about 63.93 over the coming days, weeks, and months. I do want to point out that normally in a ending diagonal, if we say, well, this one has completed as a ending diagonal, and this would then be wave 5. I'll show you the alternative. We have not reached the normal standard Fibonacci targets for a wave 5. Now, normally that is the 161.8 to 176.4. The third wave in a ending diagonal tends to target the 123.6, 60.60. We got 60.90. Then the fourth wave goes to 76.4, sometimes 61.8, at about 58.06. Well, we got very close, definitely here early January, and also once again today. Okay, so that's good. However, the all-time high we made last week only got to the 138.2. So it fell definitely short, about 100 to almost 200 points from its ideal target zone. Now, it doesn't have to be ideal, but it's a little odd. So that's why we prefer this last fifth wave, because it seems odd for the market to really not follow standard Fibonacci-based impulse patterns if it just did so prior. Also here, extremely oversold, so the risk-reward is pointing towards reward. The alternative is similar to the NASDAQ 100, that we've completed a larger fifth wave, and we're now in a impulse lower. We're going to bounce higher to about 6,000, 6,070, maybe 6,090, and then we're going to move lower. That is our alternative. So we've completed all of 5 of 5 of 5. Now again, it seems odd because we fell short of even the minimum upside target of 62.89, somewhere around there. So it's a little odd, but again, the market doesn't have to follow standard Fibonacci-based impulse patterns. Again, it did so for the third and the fourth wave, so it's a little odd the fifth wave didn't do so. So we'll have to go by price, and so far we've now closed above the first warning level for the bears, 59.30. If we go above 60.84, as I mentioned here, then I believe we should really look forward to this higher level at 62.89 or possibly as high as 63.93, depending again on what exact extension. If not, so if we top here at around 6100 and then break below today's low, that is the key signal that this wave 3C has happened. So we should see something like this and then this. I'm merely pointing out the potential. I have zero indication this is the case, based on the weight of the evidence I just presented with extreme bearish sentiment, a seasonality that points towards a rally further into the year, and an AD line that just broke above the downtrend line. It strongly suggests that this is indeed just an alternative. We'll just follow the alternative until proven otherwise. Okay, we'll just track it. We prefer, of course, the preferred wave count. IWM looks also very close to completion of this red wave 4. Can still do one more sequence lower, that I've missed one wave. It doesn't have to. Okay, so it can still go to 210 to about 202, somewhere around there. But we got today very close at 210.96, so beggars can't be choosers. And again, it was pretty oversold. And now we just have to see if it's going to fill in one more 4-5 sequence or if it's done. If we break above, I would say, this week's high at about 219, then odds really increase that the low is in place. And certainly if we break above 222 on the IWM. So again, there's good risk reward. The risk at current levels is about $4, maybe $12, and the reward is all the way to 253, which is $40. So please keep that in mind. There's never no risk. Last but not least, the most discombobulated index I've ever seen, the semiconductors. What a mess. Again, so far only 3 waves lower, can turn into 5. We are right at the CSA extension, and this would be an A, a B, and a C. And then we might have to move this whole red wave B to today's low, and then we still get a red wave C to 5,700 to close that gap. We did close the deep seek gap, okay, but otherwise this is such a mess that this is one interpretation of a very uncertain index. I don't really like it. to constantly move the goalpost on this one. This is so discombobulated. I don't really know what to make of it. So we have the warning levels on the map, and we'll see if we're going to break above these levels, yes or no. Please note we're in a strong downtrend with price below all moving averages and above below its Ichimoku cloud. So this is a very weak index that hasn't gone anywhere almost for a year. Compare that, for example, to the S&P 500, which is now also back above its Ichimoku cloud, but only below the 50, 10, and 20 moving average, but still above the 200-day. This is a much more positive chart than this one, and I don't like to trade wave counts that constantly need adjusting. This is such a mess, such a sideways slop, that it's very hard to nail down exactly what's going on, and every single time you think you figured it out, it's something else. So I don't like it, but I just want to present it to you that it's possible that we still get another C wave lower of a very complex double corrective ABC pattern for this B wave. All right, that's all we have for today. As usual, all we can do is anticipate, monitor, and adjust. We're never entirely 100% reliable. There are no market gurus. We are no prophets. We use the weight of the evidence approach, and it looks like things got way too bearish out there with extreme readings akin to what we saw at the end of 2002 and 2009. And that suggests that we would see very strong rallies. Even August of last year had similar readings, and all of it eventually turned into very strong rallies. That is still our preferred wave count based on the daily charts, the weekly and the monthly charts as well. And as always, we say trade safe and have a great and wonderful weekend.